The broadcast is now starting. All attendees are in listen-only mode.
Good morning and welcome. We'd like to thank you for joining Conexus SG and Binary Stream today for our webinar on ASC 606, Don't Be Caught Unprepared. My name is Taylor Hodges and I'm the Director of Client Success at Conexus SG. I'll be reaching out following the webinar with additional information about how Binary Stream's suite of products for Dynamics GP can help you manage the new revenue recognition rules and compliance concerns. During the webinar, everyone will be on mute, but please feel free to type your questions in the chat box and we'll address them at the end of the webinar. Now I'd like to turn it over to Neil MacDonald with Binary Stream.
Thank you, Taylor. Again, my name is Neil MacDonald. I am a solutions consultant here at Binary Stream Software. I've been in the GP space since about 2007. A lot of management and business experience before that. I am an accountant, have been for about 20-something years. One of the things that shocked me about ASC 606 was the vast size of it. The changes are going to happen for a lot of companies. And since then, a lot of the fact that a lot of customers just are not ready for it. They're still waiting. They're trying to figure out what it is. So let's jump in and talk about ASC 606. We want to talk about what it is. How is ASC 606 going to affect your business? Learn how to handle the revenue recognition principles in ASC 606, not just in theory, but also we'll talk about Dynamics GP as well. And then we're going to talk about some products that we have that will help you to do that. So by way of agenda, we're just going to go through a couple slides here. What is 606? We're going to spend a little bit more time on the 5-step recognition model. ASC 606 is very deliberate in how you are to recognize your revenue, and it walks through 5 steps that you need to understand, that you need to know in order to implement 606 properly. There also are some areas of concern. This is a large change for accountants, but not just accountants. This will affect your entire organization, as you'll see. And then again, we'll talk about how you can be 606 compliant in Dynamics GP. And we're going to talk about the hard way. I'll show you a couple examples, and we'll talk about the easy way. So ASC 606 is a new accounting standard called Revenue from Contracts with Customers. Basically what it is FASB 2014-09 and IFRS 15 if you are an international standards user. This is one of the few times when both IFRS and FASB have come together and come up with a single standard that is global in scope. Basically what they've done is they've updated the revenue recognition standards across all industries, across all geographies, across all capital markets, with a few minor exceptions, things like leasing, insurance, banking / financial instruments. So why would they do that? Basically, it's so that financial statement users, financial statement analysts, that kind of thing, can look at any business in any geography, in any industry, and be able to make a very easy comparison without having to know and study and manage different standards across different geographies and different businesses. So basically what it's doing is reducing the number of requirements. However, on the flip side of that, it is greatly expanding the disclosures to your financial statements. A lot of the standards that you're using today, there's a 605, ASC 2009-13, SOP 97-2, and virtually all other revenue recognition standards under FASB and IFRS are going away and being replaced by ASC 606. It will remove reliance on things like vendor-specific objective evidence or third-party evidence. And it adds some new revenue recognition elements as well. We're no longer going to be talking about deliverables. We're going to talk about performance obligations. Those performance obligations require distinct identification in your contracts. It talks about, in 606, variable consideration and the time value of money. These are a couple new pieces in the standard. And it talks about recognizing not based on delivery, not based on collectability, although those are obviously still important, but based on transfer of control. One of the things you'll find as we're going through is that there are a lot less rules in ASC 606. Today's standards, if you're going through them, will talk about what you can or must do, or what you cannot or must not do. ASC 606 is more principles based. It's going to give you the 5-step model, it's going to give you some examples, and then tell you to use your judgment in interpreting ASC 606, and then disclosing your interpretation in the footnotes to your financial statements. So let's look at the 5 steps. Number 1, we need to identify, first of all, do we have a contract with a customer? And if we do, what is the breadth and the scope of that contract? Within that contract, we need to identify each of their performance obligations, identify and determine the transaction price for each performance obligation, and then allocate the revenue based on each performance obligation's standalone selling price, or SSP. Then we're going to recognize revenue upon satisfaction of the performance obligation based on control. Let's go through these one at a time. First of all, let's identify the contract. According to ASC 606, a contract is an agreement between 2 or more parties that creates enforceable rights and obligations. Notice that this is contracts with customers. There are other contracts out there that your business may be involved in, things like partnership agreements. That does not apply. This is revenue from contracts with customers. Those agreements, in order to be deemed a contract under ASC 606, must have commercial substance. They must be approved by all parties. And that approval can be done in multiple ways. It might be that you have to have a purchase order with a signature. Maybe you have to sit down and have your lawyer sit down and hammer out and chisel out a contract. In some parts of the country, it could just be a gentleman's handshake. ASC 606 talks about whatever is your customary business practice to generate that approval. The contract must have identifiable rights regarding the goods and services. What are they? How do they transfer from my control to your control, and so on? What is the timing of that? There must be specific payment terms, and there must be a probability of collection. Of course, that's never going to go away in revenue recognition. We always have to look at the probability of collection, or probability of you getting paid. And it does speak of a threshold of around 70% certainty. If you have a situation where none of these things, or not all of these things, are in place, you may have cash in hand that you cannot yet recognize as revenue. If there is a modification to a contract, a change in scope, a change in the number of goods and services, the dollar amount of those goods and services, that could result in a brand new contract. ASC 606 talks about how you treat related contracts. If you have multiple contracts that are entered into at or around the same time, or if one is dependent on the other, then under ASC 606, you need to treat those as a single contract. And you have to ask yourself some questions, like, were they negotiated as a single commercial objective? Just because they're on 2 separate pieces of paper and signed 2 separate places does not necessarily mean they are multiple contracts under ASC 606. Does the consideration for one contract depend upon the performance or the price of the other contract? So if you cannot fulfill contract A until contract B is fulfilled, under ASC 606, you would treat them as if they were a single contract. Are the goods and services a single performance obligation? Even though there's multiple contracts, you may have to treat them as a single contract. Let's look at a couple examples of the contract. Let's say you have a customer agreement, you've talked to the customer and you begin work, but there's no signatures yet, there's no physical piece of paper that's signed. The work begins, you incur some costs, you may even start delivering some of those services to the customer. Can you count that revenue? Well, you have to ask the question, is there a contract? And if we go back and think, what is my customary business practice? If my customary business practice, and every other time I recognize revenue, I have that signed document, that purchase order, whatever, I may have to defer the revenue from this particular contract because it doesn't qualify under that definition. So the way that we write our contracts, the way that we think about them, the way that we fulfill them is going to change whether or not we can recognize revenue. What if we have two different contracts, one for a piece of equipment and one for a service contract on that equipment? Is that in fact two separate contracts, or is it one? Well, can you have one without the other? So I can look at contract A, it's for equipment. Yes, I can buy equipment, I don't need a service contract. But if I don't own the equipment, would I buy a service contract for it? Not likely, right? So in that case, you would treat them as a single contract. And again, we have to look at whether or not there are distinct goods or services being added later. Are there implicit services coming down the road? And changes in a contract, again, may result in either a new contract starting today. It could mean a catch-up in a contract where we have to go back all the way back to day one and restate the revenue. So ASC 606 at the very back, if you download it from the IASB website, it's about 150, 200 pages. There's 64, 65 very detailed examples in the appendix at the back that go through all of these steps and say, you know, in a particular industry, if I were to do this, how would I recognize revenue? And it walks you through step by step. It is very good reading if you are in question about how to follow ASC 606. So, okay, so we've identified that we have contracts. Now we have to go through our contracts and identify the performance obligations. Basically, a performance obligation is any promise in a contract with a customer to transfer goods or services. It could be a single good, it could be a series of goods or services as well. And if the contract consists of more than one good or service, you would account for them separately only if they are distinct. Well, what does that mean? That means that if a stranger to your business was to walk in and look at one of your contracts, could they look at that and say, I see what the good or service is, and I can determine that the customer can benefit from that obligation on its own or with resources readily available to the customer, and I can see in the contract that it is in fact distinct in terms of the contract. I can identify one performance obligation from another. If you cannot do that, if somebody that is looking at your business from a third-party perspective could not look at your contracts and come to the conclusion that both of those would be yes, then you may have an issue with identifying performance obligations, accounting for them separately, and that may mean that you may want to look at, as of the effective date of ASC 606, rewriting your contracts such that that is possible. Here's an example. Let's say we had a contract to deliver a computer system. If I were to look at that contract, are you delivering a computer system, which reading it could say, you know, that's one performance obligation? Or can I tell that there are in fact three? There's a hardware component, a software component, and a service contract. Again, it depends on the wording. We cannot assume that someone would think that a computer system consists of those three components. The computer system is pretty easy, but what if you're selling some kind of specialized machinery? As an outsider, I may not be able to recognize that there are in fact distinct performance obligations that you think are there. So make sure that your contracts are written properly. Is there a promise for additional goods or services? That could be a different, separate performance obligation, and that could result in having to defer revenue until such time as that performance obligation has been satisfied. Okay, we've determined we have contracts. We're going through the contracts, we can see our distinct performance obligations. Now we have to determine the transaction price. Well, that would be the amount of consideration to which an entity is entitled for transferring those goods or services. Under ASC 606, this must be determined at contract inception. That is a difference with IFRS 15. IFRS 15 allows you to determine that transaction price for some performance obligations at a later point in time. Under ASC 606, it must be determined at contract inception. It also talks about reassessing that transaction price at each reporting period. Has something changed? Has your salesman gone and renegotiated the deal. Maybe it's a license deal, for example, and you've got 1,000 licenses at $30, and partway through he's gone in and they've offered an additional 500 licenses at $25 or something like that. Has that changed the transaction price based on that contract? You would have to reassess that. ASC 606 talks about variable consideration. This is new to the RevRec literature, and it talks about a combination of two things. One would be the most likely amount, and that's all or none, right? I've got a bonus based on fulfilling the contract. I'm either going to get the bonus or I'm not, yes or no. Or it could be an estimated or expected amount, which is the sum of probability weighted amounts. And whichever method that we choose at the beginning, the inception of the contract, we must apply consistently throughout the contract. So again, if you go back to the literature, example number 21 in the appendix talks, for example, about a contract that's $250 million plus or minus $10,000 for each day that you are either early or late. Based on an inspection rating of that thing that you're building, there is a bonus of $150,000. So as you're going through and calculating your revenues and how much revenue you can recognize, maybe this is a construction company, you're doing a cost plus kind of thing which is allowed, and we're trying to determine how much revenue do we actually recognize. Well, you have here one performance obligation, but you actually have two variable amounts. One, based on the expectations, we would figure out, do I expect to deliver early or late? And based on your history of similar contracts, you may say, no, I expect to deliver X days early, X days late. There's also the most likely amount, which would be all or nothing for that bonus. Have you had success in other contracts like this? Do you normally get that bonus as opposed to normally not? So as you're figuring out the amount of revenue that you would be looking at, you would have to look at both of these variable amounts and take these into consideration. ASC 606 also introduces a new component, the time value of money. Now this is only if it is significant and only if it's greater than 1 year. Basically what they're saying is if you enter into a long-term contract where either fulfilling the performance obligation or the payment of that is deferred for one reason or another, essentially you're creating a loan with either interest revenue or interest expense. Some examples might be, for example, if you have a long-term contract, your average contract, say, is less than a year, but greater than $50,000. Would contract A, which is 2 years, $2,000, fall under this particular guidance? Well, again, what is significant in your business and what is normal? So that's not a question that I could answer, right? You would have to look at what is my standard business practice? What rate would I use in calculating that interest component? Well, ASC 606 talks about the prevailing rate in your industry or your geography. It might be a rate that's implicit in the contract as well. That could certainly be used. This is an area where, as you can see, a lot of judgment is required. This is not a, you must do this, you must do that. You have to look at the situation, look at what's normal. Is this one normal? Is it different? Is it significant? Is this the right rate? Talk to your legal teams. Talk to your revenue recognition teams. Talk to your internal and external auditors. And whatever decisions you come to, make sure they're documented in the disclosures to your financial statements. ASC 606 also talks about non-cash consideration. And again, this talks about treating it at fair value at contract inception. Again, the difference with IFRS 15 is it could be determined at some other point in time. It talks about things like equity, contributed goods and services, that kind of thing, where you're doing almost a barter type system. Any changes in fair value after contract inception is not an increase or decrease of revenue, it's actually a gain or loss to the operations. There's also a section that talks about consideration payable, such as rebates. If that applies to you, again, make sure that you understand and read that section of ASC 606. All of these things come into play in determining the proper transaction price. Okay, we've got contracts, we have performance obligations, we've determined the transaction price for the performance obligations. Now we need to allocate those across the contract. How do we do that? Well, we have to look at each performance obligation's standalone selling price. That's the price at which an entity would sell a good or service to a customer separate from all other goods or services. And it may be that it's not directly observable. So you may have to go out and use things like market conditions, cost plus margin calculations, something like that, to determine what would the standalone selling price be of a particular performance obligation. This replaces what we call fair value in today's accounting standards. And basically, what we have to do is look at what would I sell that item for? And if I don't know, maybe it's a brand new item, what would a competitor sell that item for if they were selling it absent all other components? Notice the second major bullet here. This is a quote right out of ASC 606 that I thought was significant. It states the contractually stated price may be but shall not be presumed to be the standalone selling price. So just because a contract says I will sell you a blue widget for X dollars does not mean that's the standalone selling price. That really comes into play when you have items where the pricing can be highly variable. If your sales guys can go out and negotiate whatever is the best deal for your company and your customer, maybe sell it for $1 million to one customer, 900,000 for another, and $1.1 million to another, just because that's the number that's in the contract doesn't mean that is the standalone selling price. So you would have to determine what that is. And again, there's different ways to do it. Adjustable market assessments, maybe you look at, my average sale over the last X number of months, cost plus margin calculations, things like that, but make sure that it's disclosed. Whatever that judgment call is that you make to determine that standalone selling price, you need to be able to justify it and document it in the notes to your financials. The residual method is still there in ASC 606, but not to the extent it was in the current accounting literature. It talks about using it for things that are highly variable, or maybe a new product that you just cannot determine a standalone selling price for it yet because it is so brand new. So you would have to allocate the revenue for the other items and then use the residual value for that unique or highly variable item. Here's an example. Suppose I'm selling computer systems and I'm going to sell you a computer system for $1,000. But in my contract, I clearly state that there are 4 performance obligations. I have to then determine what would the standalone selling price be of each of those distinct performance obligations. So the CPU has a standalone selling price of $700, the monitor $300, the keyboard $100, and the service contract, which of course would be deferred revenue if it's a 12-month contract or longer, for $100 as well. Now that totals $1,200. Well, how much revenue do I apply to each item? Well, the formula that's given in ASC 606 is to reallocate the revenue based on the relative standalone selling price. So for example, look at that computer, that CPU. It has an item standalone selling price of $700. We would then divide that by the sum of all the standalone selling prices, so we have its relative weight of that $1,200. Then we multiply it by the actual contract price of $1,000. So the revenue that goes to that CPU is not $700. It is in fact $583.34. And we do that for each component in that contract, all the way down through. You notice the one that probably makes the most difference in this is that service contract, because we have to make sure that we both recognize up front the correct amount, but also defer the correct amount, right? We think of a lot of these accounting standards came into play because there was some loose and wild stuff happening in the olden times, the Enron and WorldCom days, where revenue was recognized before the deliverables happened, before the satisfaction of that, and then it was just recognized at the wrong time. Companies went out of business, a lot of people lost a lot of money. So in this case, it's $83.33. We might be looking at that going like, big deal. 100 versus 83, who cares? It's insignificant, it's immaterial, right? That's an accounting principle that a lot of us probably live by, right? It has to be material to make a difference. But what if I have 100,000 of these? What if I add an extra few zeros on the end? All of a sudden, it becomes a significant amount. And I have to make sure that my financial statements are showing the correct revenue recognized today and the correct revenue being deferred. Now, bear in mind that none of this matters if these are not distinct in terms of my contract. If my contract simply said, I'm selling you a computer system for $1,000, I don't have distinct performance obligations. I don't have to figure out standalone selling prices. However, I would then have to defer the entire $1,000 because there is a deferred component to that. So you can see now it's significant. There's a big difference between deferring $83 and deferring $1,000, to the point that if you had enough of these, it could make you financially unstable as far as your creditors are concerned. So the way that your contracts are written is very, very important. Okay, so now we're going to recognize the revenue, but upon satisfaction. ASC 606 says that upon satisfaction of a performance obligation, which is by transferring a promised good or service to a customer, and that good or service is considered transferred when or as the customer obtains control. It does state that we may recognize revenue at a point in time. So if we have a single performance obligation, or even a group of them, but we can say to our customer, here you go, the contract's done, I fulfilled my part of it, there's all the performance obligations, you now have an obligation to pay, we're done, we can recognize the revenue. It might be something that's dissatisfied over time or deferred, and there's some examples given or some clauses in there that state when you might do that. If the performance creates or enhances an asset over time, which the customer controls as is created or enhanced. A landscape business might be a good example of that, right? A landscape business may go in and spend a whole summer doing work for a customer. The customer has control of the yard, but that work is being delivered over a period of time. Or the performance does not create an asset with an alternative use to the entity providing the good or service. Think of a construction contract. If I'm own a construction company and you hire me to build a shopping center and it takes 3 years, well, obviously I'm going to want to recognize revenue over time. Even though you can't use that shopping center yet as a customer, it is no use to me. That's not my business. I build things. I don't run shopping centers. So in that case, I could, using something like a cost plus calculation, recognize revenue over time. Or if the benefits are received or consumed as the performance takes place. A typical example of that would be a service contract or an extended warranty purchased separately from the actual component itself. The recognition of these things over time could be straight line, simply X dollars per month over 12 months, like a service contract. It might be based on events or milestones, very similar to a construction contract. When you reach a certain milestone, you can collect certain amounts of money and recognize revenue, or might even be based on a percentage of completion. The key to this, if we look back in that definition, is as the customer gains control. Well, what does that mean? The customer gains control when they have a present obligation to pay, when they have legal ownership or title, when they have physical possession, when they enjoy the risks and the rewards of ownership, and they accept the performance obligation. All of these must be in place. This is not one or the other. All of these must be in place. So again, think of the way our contracts are written. You have to be able to satisfy each of these in order to say the customer has control. Where this gets tricky is that last bullet. The customer accepts the performance obligation. You may think that you have fulfilled your rights or your obligations under the contract, but if that customer is not happy, if that customer, say, decides to sue you, have they accepted the performance obligation? It could be argued that maybe they haven't. So all of these must be in place. So those are the 5 steps. We're going to identify our contracts. We're going to identify within the contract the performance obligations and ensure they are in fact distinct. We're going to determine the transaction price of each of the distinct performance obligations. Then we're going to reallocate or allocate the revenue, not based on that transaction price, but on each item's standalone selling price. And then we're going to recognize the revenue upon satisfaction. So with all that said, you're probably thinking of a whole bunch of areas that, oh no, what do I do about? Let's talk about just a few of those. First of all, are you ready for ASC 606? This is not a case where you can do nothing at all and the magical will happen. You need to start getting ready. Why? ASC 606 takes effect for public companies and not-for-profits for fiscal periods beginning after December 15th, 2017. Yes, you're reading that correctly. That is literally 2 months from now, month from now. It's coming. It's coming fast. If you are a private company, you have an additional year. Now, you can adopt early. If you're ready to go, you can adopt the same as a public company. But if you are a publicly traded company or a not-for-profit and you have not yet started to get ready for ASC 606, the time is very, very quickly running out. Make sure that you look at your contracts. Make sure that your contracts are distinct in terms, or your performance obligations are distinct in terms of that contract. Make sure that you are selling, whether or not you're selling solutions versus products. If you sell a solution that in your mind comprises a whole bunch of things, but in terms of the contract it doesn't, you may have to rewrite your contracts. Again, we come back to that hardware, software, and service agreement. If they're not distinct, you may end up deferring even the hardware and the software, which could certainly change your financial position. Look at materiality as well. This has never gone away for accountants. Even though an item might be distinct in terms of the contract, if it's immaterial, you don't have to worry about it. You can elect to fold it into another performance obligation. Just make sure that if you decide to do this, that you disclose it. If you are in the business of licensing anything, ASC 606 has an extensive section on licensing. Rather than going into a lot of detail here, make sure that you download, review that section. Again, talk to your auditors and your accountants. ASC 606 talks about two different types of licenses. It originally said right of use and right of access, and then they changed that in an update just a few months ago, and they're talking now about functional IP versus symbolic IP. Functional IP, or right to use, can be recognized at a point in time, and it gives examples like software, drug formulas, completed media content, that kind of thing. That is a significant change for the software industry. SOP 97-2, which most software companies are using today, first of all, a lot of it gets pushed under the residual method, so your revenues kind of waits till the end of the contract, and then it's deferred over the expected life of the software. Under ASC 606, software revenue can be recognized at inception of the license, not over the term. So this can accelerate revenue for software companies. The symbolic IP, which will be recognized over time, are things like leased or purchased brands, trade names, logos, franchise rights, that kind of thing. Again, if licensing applies to you, make sure you read that section. ASC 606 is also ongoing. It is not something that once next year comes along, you can say, great, we're done, we wash our hands of it, we're compliant. ASC 606 says that on each reporting period, you have to either individually or by portfolio review your contracts. Are they still contracts under the definition of ASC 606? Are all of those components in place to allow you to recognize the revenue? You can do this based on a portfolio if you have an entire group of business where the contracts are identical, so you don't have to do it contract by contract, but you do have to do these reviews and you have to justify that you've in fact done them. You have to do the same thing with the performance obligations. Has something changed, the pricing or the amounts? Has anything changed that might trigger either a catch-up of this contract or the creation of a brand new contract? And I just received a little while back the RSM Financial Reporting Insights for September 2017. And they had a really good article in there that talked about 5 key considerations, and I thought it was important enough to bring it out in this webinar. Number one, it talked about how the adoption of ASC 606 is not just an accounting function. You know, we think of an accounting standard and we think, well, you know, that only applies to the accountants. Well, that's not true. Yes, it is an accounting change, but is it going to change our tax office, right? The revenue that we recognize, the revenue that we defer changes our tax position. What about the C-suite? How does that affect how they're talking and looking at competitors, how they're talking to the board? It's going to make some changes. What about IT? Can your systems even handle ASC 606? Do you have to look at doing upgrades, maybe swapping out, putting in an entirely new system, right? It becomes an IT function as well. Look at your legal team, your contract team. I mean, you may have to go back and rewrite all your contracts. Obviously, you can't change the ones that are sitting there today, but you may want to rewrite or write how they change in the future so that they're compliant under 606. This is not just an accounting function. And RSM says, do not underestimate the complexity of ASC 606. We just talked about the dates. Man, those dates are coming so fast that if you have not started, you better get started and start bringing other people on board to get it done, because it is, again, as we mentioned, a company-wide effort. It's going to affect virtually every department, and everybody needs to understand what's happening. Point number 3, when ASC 606 goes into effect, the method of adoption is going to have a significant impact on the level of effort. When you adopt ASC 606, you have to do 2 years of retrospective accounting. They talk about the full retrospective or the modified retrospective. The full retrospective basically says you have to go and restate every single contract for the prior 2 years as if ASC 606 was in effect. Now, obviously, you're not going to refile those financials. They're done. But when you present your financials starting January 1st of next year and you do your 2-year comparison, under a full retrospective, you would have to show 2017 and 2016 as if ASC 606 had been in place back then. That means every single contract for the last 2 years has to be restated. The advantage of that, while it's a lot more work, is it's going to give you true year-over-year comparability, because you can see what 2018 looks like under 606, and you can very easily see 2017, 2016 under 606 as well. The modified retrospective basically says only for those contracts that are still open as of your adoption date, you have to now restate those as if they were under ASC 606. And then you have to do a line-by-line financial statement disclosure as to what those changes were. So you can ignore the prior 2 years, all those contracts that have been closed already, but any contract that is currently open must be restated as if it was under ASC 606 and then complied with from that point forward. And again, line-by-line disclosure. Would it be easier? Probably. The downside is year-over-year comparisons are very difficult, because 2017 will be short 2018 under ASC 606, the prior 2 years will not. So you have to decide which is the best approach for our business, for our shareholders, for the analysts that are looking at our financial statements, especially if you're a publicly traded company and you rely on those analysts to keep you in business and then to promote your company. What is going to make it easier for them? The full retrospective gives the comparison, but is much more complex to actually make happen compared to the modified. Step 4, or number 4 here, they talk about how the 5-step approach is a significant amount of work. Maybe as we're going through them, you're thinking about your business, your company, your contracts, your customers and performance obligations and control, and it's a lot of work. Get started. And they also counsel that revenue recognition is only the beginning. There are other accounting changes. If you are also in the leasing business, for example, ASC 842 is a change for leasing. And under ASC 842, if you are a lessor, your revenue recognition from your leases must comply with ASC 606. So it affects you there as well. So if you're not, if you don't get this newsletter from RSM, it's their Financial Reporting Insights, I would strongly suggest it. There's a link here where you can click on this. It'll take you right to the article. Sign up for the newsletter. It's got some great accounting information ongoing. This is one I found on ASC 606. So the reason we're all here today, though, is not just to learn about ASC 606, but to learn how we can handle and be compliant with ASC 606 under Dynamics GP. How would you do that? Well, if you're sitting there looking at GP out of the box, you can't. But there are two options. You can do the hard way or the easy way. The hard way would be something like an Excel spreadsheet, being able to go out and manually build out your contracts and the standalone selling prices and so on. Or you can use a third party or an ISV application. That would be the easier way. Let's look at the options. So let's say we wanted to use Excel. Probably everybody on the call here is an Excel user. We can all create formulas. We can all put the numbers where they need to be, and we can look at that formula and we can extrapolate out what our standalone selling price, our reallocated revenue can be. And of course, we can all write journal entries to bring that correct revenue back into GP. That's easy. But if you have enough of them, it can be time consuming. Depending upon the complexity of your contracts, it could be a big job. And unless you have more than just a handful of contracts, that's probably not the best use of your time. Let's look at an example. Suppose I have a contract, and this is a very simple one. I'm going to sell on my contract hardware, $15,000. I'm going to bill it one time. I've got a setup fee of $5,000. I'm going to bill it one time. I've got monthly software of $7,000. Over my 2-year contract is $168,000. I have an annual maintenance contract of $12,000. Of course, I'm going to bill it annually and defer it. That's $24,000 contract value. My professional services is $3,000. That is going to be deferred as well. Even if I bill it up front, I cannot recognize it until I actually deliver the service, right? That's part of the satisfying that performance obligation. And then my sales guy has negotiated a $1,000 discount on this contract. So it turns out it's a $214,000 contract. So far, so good. Now I have to look at, I've got my contract, I've got my performance obligations. What is the standalone selling price of each of those performance obligations? I see my sales guy has actually discounted the hardware from the standalone selling price of $17,000. The setup fee is fine. Look at the software. The standalone selling price of that software is $8,000 a month or $192,000, but the contract value is $7,000 a month or $168,000. And then we've left the other two items alone as well to make it easy. So my annual contract and my professional services will stay as they are. What that means, though, is that my standalone selling prices of my contract add up to $241,000. Obviously, I have to reallocate the revenue to make sure that the correct amount of revenue is recognized up front, or periodically, as the case may be for some of those other items like the software, and deferred, as in the case of the annual maintenance contract and the professional services. So how do we do that? We're going to create in our spreadsheet the calculation that determines the reallocated contract revenue for each of those performance obligations. Remember the formula that we were looking at a little while back? Let's apply it here. Let's look at the software. We're going to take the item's standalone selling price, that's the $192,000. We're going to divide that by the contract total standalone selling price, or $241,000. We're going to then multiply that by the contract value of $214,000, which gives us $170,489.63, or a periodic revenue of $71,0373. And we do that same formula for each of the items. So as I said, it's not impossible to do. This is an Excel spreadsheet. It's fairly simple to create these formulas and extrapolate this out. But now what I have to do is when I bill my customer, I have to adjust the amount that I'm billing for the amount that I'm allowed to recognize. For example, Here on the right, or the left, sorry, is the invoice. I'm going to invoice my customer $41,000. However, I'm only allowed to recognize $39,958.50 of revenue based on that reallocation. If I simply post a $41,000 revenue, I am misstating my financial position. It's only $1,041, who cares? Well, if it's only one contract, probably nobody. But if this is your business and you're doing hundreds or thousands of these daily, weekly, monthly, that difference could add up to be tens or hundreds of thousands or possibly even millions of dollars. Now it is significant. On the right-hand side, we see what my distribution would look like. Yes, my AR is 41,000. That's what I'm billing the customer. But I have to reallocate or use those reallocated amounts for the revenue, and then I've got to pick up that $1,041.50 and hang on to that somewhere. It's in a deferred account. I've called it the contract revenue clearing account. You may call it something else. And every month as you bill, you're going to do the same thing. Think about what's going to happen next month. If I bill $7,000 worth of software, I'm allowed to recognize $7,103.73 worth of revenue. So again, I have to do that manual. In this case, it would be not a credit, but a debit of $103.73 to make up the difference. And I would have to do this for every single bill, every single invoice period for the life of this contract. That becomes, as I said, time-consuming, complex, and probably a huge waste of your time. Let's look at another option. Again, I work for Binary Stream Software. One of the products that we sell and our friends at Conexus SG talk to their customers about on a regular basis is our subscription billing suite. It comprises three components. There is an advanced recurring contract billing, there is an advanced revenue and expense deferrals, and then a brand new piece that we've added for ASC 606 compliance, which is the multi-element revenue allocation. These are all fully integrated Dynamics GP modules. At no time do you have to go out there to Excel or out there to any other system to have this happen automatically inside of Dynamics GP. We allow line level billing, either scheduled or milestone-based billing to fit your industry. We have either straight line, milestone, event-based, or percentage of completion, line level or item level deferrals. We also then allocate the revenue using those standalone selling prices based on an amount that you can store in the system, based on the amount that you invoice for those items that are always sold for their SSP, based on the list price. So you can use the list price as the SSP, or even a percentage of other items. There's more information on our website on each of these, but let's just very quickly talk about some of the key features. The advanced recurring contract billing, again, scheduled or milestone billing. So if you want to bill so much per month, we use the straight line or the scheduled billing. Perhaps your contract is written such that you're going to bill, say, 10% on contract signing, you're going to do 50% upon implementation, another 30% upon user acceptance testing, and the balance when the training is done. You know those things are going to happen, but you're not in control today as to when. So we can set up a milestone schedule. As you achieve the milestone, we would bill the correct amount. We give you line level control of those billing parameters. So you can have, like that contract example that we showed, some one-time items, some recurring items, some deferred, some non-deferred items, all done and controlled at the line level. We have a component that allows us to do metered or consumption-based billing as well. So if you're billing your customers based on the number of hours, the number of minutes on an IVR, the number of service tickets, the number of widgets that they consume, we can handle that as well. We also have a true tiered or cumulative pricing module where we can tier the pricing, not just at that tier level, but we can accumulate or do cumulative tiered billing. And of course, it's fully integrated with our advanced revenue expense deferrals, so those line items that need deferrals can be deferred. That, again, we can do based on straight line or based on milestone. Maybe you can't recognize revenue until you've achieved a certain milestone in the project. We can handle that. Again, we're doing it at the line level, not at the distribution level. So on a single invoice, I could have a 1 year and a to your deferral, I don't have to go in behind it in the distributions and play around and say, hey, this one's this amount for this period of time and this amount for that period of time, like you would have to do in GP standard deferrals. We're doing it at the line, at the item level. So you don't need to manually allocate that template or that profile. We don't post to future periods. This is a huge one for accountants. I run into a lot of accountants saying, you know, I don't like other deferral products because they post to future periods. If I've got a 5-year contract, there's no way I want something touching my general ledger 60 months out. I have yet to meet an accountant that thinks that's cool. We play in this month, maybe next month, but you don't touch the general ledger out there. We don't do that. We'll build you the schedule. You can see what it looks like next month, next quarter, next year, the next 5 years, but nothing touches the general ledger until you want it to touch the general ledger. And then the multi-element revenue allocation piece, this is where in the system we're going to set and define that SSP. Again, we call it fair value today, but it's a standalone selling price under ASC 606. We're going to tell the system using a multi-element allocation ID which items belong together, which ones are part of the same contract. So for example, I could take these items, we notice in the third column from the left, they all have the same identifier. So they're all part of that same contract. And then I've got my fair value method there. I've got the extended price, it looks at the fair value, and then it takes that and changes it and does that recognition amount. Way over on the far right, when I create my invoices, that is the amount that will be recognized as the revenue on those items, despite what their actual extended price is. So it's compliant with ASC 606 for single or multiple contracts. We've also added some SSRS reports. Everybody that looks at our billing product or our deferral product says, hey, you know, I need an MRR report. Done. I need a contract value report. Done. I need my revenue waterfall and my deferral balance, my declining balance report. Done, done, and done. We've built those in all part of the core modules. We've built a new portal that allows you to do a complete quote to cash system. You can start in your CRM. You can push that through to through the eConnect nodes into GP, into our advanced recurring contract billing, or directly into an SOP module. The customers can then come in from the other side into the portal, log in. They can see their contracts. They can see what their future billings are going to look like. They can look at any AR or SOP documents, whether they came from our recurring contract billing or are just standard GP documents, and they can pay those right online. We have revenue allocation that allow you to take a single item and split it into multiple performance obligations across multiple deferral accounts, multiple recognition accounts. So that one that we looked at with the variable amounts, it was a single performance obligation, but it could have 2 different revenue recognition models. We can handle that as well. And of course, we have the eConnect nodes already built, so that if you are using some kind of a front-end system, a CRM, a Salesforce, something like that, to build your contracts for your sales guys, they just simply push a button and using Scribe or Smart Connect, pushing it through the eConnect node right into Dynamics GP. So, just going to wrap up very quickly here and then jump and see if there's any questions. We talked about ASC 606. What is it? How does it affect my business? We talked about the 5-step recognition model. We talked about how we're going to handle it in GP. You have options. You can do it in Excel. You can go out, and there are a couple other ISVs out there. I work for Binary Stream. I'm focused on our products, but do your research. Make sure that you're using the correct solution. Again, this is not just an accounting function. It is also an IT function. Make sure your systems can handle it. If you want more information, obviously, talk to the folks at Conexus SG. Taylor would be more than happy to put you in touch with the right folks at her end. If you want more information on our products, if you want to just talk about ASC 606, my contact information is here on the screen as well, and you can see more about our products with no obligation at www.binarystream.com. Taylor, going to turn it back over to you to see if we have any questions.
Thanks, Neil. I'd like to thank everybody, first of all, for joining us today for the webinar. That was very informative and thorough. If you have any questions or want to see a personal demo or get some more information on the product set from Binary Stream, please feel free to contact me. You can reach me at sales@conexussg.com or the number listed below. Also, my email is thodges, Hodges, @conexussg.com, and I'd be happy to work with you and get you the appropriate resources. Looks like we don't have any questions. I guess one question that we get from our customers sometimes, Neil, is, you know, if people are trying to put this in place, they're trying to get the new compliance for ASC 606 ready to go, what do, in your product lines, in the product set, how long does it typically take to roll that out in one of these scenarios?
Great question. So the implementation of our products is not the bulk of the work that's required for 606. It's going to be that first time financial presentation, whether it's the full retrospective or the modified. Unfortunately, there's no product that I know of that can go back and look at your contracts from last year and the year before and rebuild them for you. So that's going to take some work. As far as implementing our products to get you ready once that paperwork side of it's been done, we're typically telling customers to plan on about a 40 to 60 hour implementation. Now, that's not 40 hours starting today and 40 hours from now we're done, right? It's spread out over a few weeks based on the availability of our folks, your folks, the customer, data import, that kind of thing. We can take existing contracts and bring them in. We can take existing deferrals and bring them in and have them recognized from this point forward in a correct manner. But again, there's a little bit of homework that needs to be done in order to do that retrospective accounting.
Great, Neil. That's really helpful. Thank you very much. I don't think we have any other questions, so please stay tuned for more information following in an email. Appreciate it, everyone. Thank you, Neil.
Thanks.
Bye-bye.